Okay, in this lecture, we're going to finish up our discussion of constant growth model or dividend discount models, but specifically constant growth model states that stocks will um, value will be greater the larger its expected dividend per share, the lower its market capitalization rate, and the higher expected growth rate of dividends. So these are the three components of the formula: the dividend, the market capitalization rate, required rate of return, and then the growth rate. So, higher the dividend, obviously, the higher the value of the numerator. If we lower the required rate of return, that's going to decrease the spread between the required rate of return and the growth rate. That decrease the size of the denominator, which is going to increase the value of the stock. Vice versa, or the same is the case if the growth rate goes up. That accomplishes the same thing, increasing the price of the stock. Couple of examples here. We've got two stocks here. We've got one with low reinvestment and the other with high reinvestment. All else equal, if we have low reinvestment, the growth rate of dividends per share is going to be a slower growth rate. If we have higher reinvestment over time, that dividends per share are going to grow faster at a faster rate. So it simply has to do with the reinvestment of the company's earnings. If those earnings are reinvested and the company has profitable projects to invest them in, it will have a higher growth rate of dividends. Now we shift to price earnings ratio. The price earnings ratio is a ratio of the stock's earning price to its earnings per share. The determinants of price earnings ratio can be analyzed using this formula here. The price earnings ratio is equal to 1 over the required rate of return multiplied by 1 plus the present value of growth opportunities divided by the earnings divided by the required rate of return, which is hopefully you recognize this as the no growth value of the firm. So if the present value of growth opportunities is 0, then the price of the stock is simply going to be E over K. So this value right here is going to be 1. So the PE is just going to be simply 1 over the required rate of return if there aren't any growth opportunities. However, the greater those opportunities, the higher the PE should be. So if we have a firm that's growing a long run, constant pace, we can simplify the PE ratio into the dividend rate, 1 minus B, or 1 minus the plowback ratio, divided by the market capitalization rate minus the growth rate, ROE times the plowback ratio. So, and finally, we'll discuss the PEG ratio. It's simply the ratio of the PE price earnings ratio or price earning multiple to the earnings growth rate. In the book, it says that the PE ratio should be approach 1 or over time. If you find a stock with a PEG ratio below 1, that is considered to be a value, undervalued stock, so you'd want to invest in that. Table 13.3 shows various plowback ratios, B. So we've got 0, 0.25, 0.5, 0.75. One thing that's missing here, which should be stated, this table assumes an ROE of 12%. So we've got, so we're looking at the ROE below the required rate of return of 12% or K of 12%. So we've got ROEs below, equal to, and above. So then if so if we look across for example, 10%, that is, if we're reinvesting nothing, then our growth rate is going to be nothing. 25% of that is 25% of 10%, and half of that is 5%, and so on. So same for these 12 and 14%. Where it gets interesting is with our PE ratio. So what happens if, in the case of 10%, we have an ROE that is less than our investors' required rate of return. So as we reinvest, our PE ratio is going to decline. What happens is if the company, basically what's going on here is the company is investing in projects that are reducing the value of the firm. So so with no reinvestment at 10%, the company's PE ratio is 8.33. So if we go to 12%, it doesn't matter whether the company's the company reinvests or doesn't reinvest, because the ROE is equal to the required rate of return. So the PE ratio is going to remain the same no matter what they do. However, if the ROE on those projects is greater, the more we reinvest, the higher that PE should be. Yeah.